So glad that you can be here. Another beautiful day here in Rochester, New York. Another beautiful day at Sage Rutty. So glad you could join me. Today we're talking about tax basics. I'm that weirdo that enjoys talking taxes. This stuff gets me excited. So hopefully it'll be fun. Well, maybe not fun, educational, valuable for you today. A quick reminder here, designed to be 15 minutes or so. Please feel free to pose any questions, and compliance would love for me to mention that this is not official tax or legal advice. I'm not an attorney. I am not a CPA. I am just a personal finance nerd, a CFP. So help people in doing some tax planning, but not official tax advice today, really designed to be education. And really the hope is just to kind of get your feet wet. I recognize that for most people, you don't get a ton of education around how taxes work, right? It's something that's going to be the largest expense of your entire lifetime, and it doesn't really get taught in school or taught. It's not just like a life skill that most people are familiar with. It's very complex, and so I'm hoping to kind of get your feet wet, like this little pup here, give you a taste of kind of how the basics work. So I wanted to start with a background on why we pay taxes in general. Right. And so I have a client, one of my newest clients is actually retired from the IRS, which, yes, is terrifying, but is also was kind of eye-opening. So I said, everyone's trying to pay less taxes. And she said, well, my husband and I were fine with paying our fair share of taxes, right? We wanted to just have a fair shake, but we like the idea of that. I have roads to drive on and public schools, and I feel safe in my home. And if my house catches on fire, firefighters are going to show up, and we have parks, and, there's grants to encourage innovation and growth. And there's all these really positive things that come as a result of taxes. It's just, wanting to make sure I'm not paying more than I have to. And I think there's this perfect quote from Ann Landers that I love. A person doesn't know how much he has to be thankful for until he has to pay taxes on it. Right. So I think that the idea of having a tax system makes sense. It's just, I want to make sure that I'm not paying more than I have to into it. Right. I want to pay my fair shake, not a penny more. And I want to work within the rules to do so. So on the very basic level of taxes, we have a graduated and marginal tax system. So what I mean by graduated is that the more money that you make, the higher rate that you're paying. So if you're married, filing jointly, and you as a household earn between the 19,751 and 80,250, you're paying 12%. If instead your combined household income looks more in the 200 range, you're paying 24%. Right? So it's graduated. The more that you make, the higher percentage that you're paying. It's also importantly marginal, which means that everyone has to fill up the buckets along the way. It's not just where you fall, and that's the tax rate that you hit. And that confuses people a lot of times, right? Okay, if my household brings home $200,000, then I'm just paying 24% in general. And that's not exactly how that works, right? Everyone has to fill up the 10% bucket first, and then fill up the 12%, and then the 22% before you land in 24% and continue onwards. So it's not your average tax, it's just what your marginal tax is. And maybe an example would make that a little bit easier. So say that you're in a household and you earn, in a married filing jointly couple, $120,000 per year. The first 19,750 you're paying 10% on, right? So you generate a tax of 1975. On the next dollars from 19,750 to 80,250, you're paying 12%. So that generates an additional $726 in taxes. And then you're up into the 12% bracket. So what your total amount is minus the top of the 12% gives you what's in the 22% bracket. Means you're ending up paying $8,745 in that 22% bracket. So to illustrate, the difference between average tax and marginal tax, your total tax there is $19,980, basically $18,000 of taxes. Your marginal rate, so if you earn another dollar, that dollar is going to be taxed 22%. If you look at your average tax, so if you take this 18,000 and divide it over your 120,000 total, you're only paying an average of 15%. Right? So it's important to recognize that your marginal rate and your average tax are always different, and your average tax is always going to be lower than what your marginal rate is. So it's pretty important to know. Don't be in a spot where oh my gosh, we're making $171,050. I don't want to get a raise because that's going to make me pay more in taxes than what it's worth, because that's simply not how it works. So how do we reduce that, right? Great. If I understand marginal brackets, how do I end up paying less in taxes? And there's 3 ways to do so. The first is to earn less. I wouldn't recommend that one, right? You can pay less taxes if you have less money. Not necessarily a good trade-off. The second is using tax credits, and the third is using tax deductions. So credits are a dollar for dollar trade-off. So if I get $1,000 credit, it covers $1,000 of total taxes, versus a deduction reduces taxable income, but it doesn't generate that total dollars in tax savings. So say we had $1,000 credit or $1,000 deduction. Going back here, $1,000 credit would lower our taxes from basically $18,000 to $17,000. A deduction would lower our taxable income by $1,000, would only save us $220 in taxes. Does that make sense? And please feel free to interrupt me if you do have questions on that. But credits way better than deductions. This is what they talk about with having kids. You get a tax credit, which is way better than a deduction, and credits are refundable. So if you have more credits than what your total taxes, you actually get to keep that money. They'll pay you back out from the system, which is pretty nice. Deductions from there are then broken down into 2 categories, in what they call above the line or below the line deductions. Above the line are deductions that everyone can have access to. So you can be used whether you itemize or whether you don't. Below the line deductions, on the other hand, have to be itemized. And what does that mean? What is itemized versus non-itemized? Well, I'm glad you asked. When you go to file your taxes every year, there's certain things that the government says, hey, we recognize you probably don't need to be paying taxes on everything, right? We'll give you some sort of break. We'll give you some earned income without paying any income tax on it. And so each year, what you do is you take a look and you say, are all of these things, these itemized deductions, I have kept receipts from my charitable contributions, from sales tax, from property taxes, state and local taxes. I kept all of these receipts. How much does that add up to? I can either take all of that, or I can take what's called the standard deduction, which is just an assumed amount. So every year when you total it all up, you take a look. If you're a single individual, you can say, okay, I had more in charitable contributions of property taxes than $12,550. I'll itemize. Or, hey, I'm in a married couple. Trying to itemize for more than $25,000 is really difficult to do. I'm just going to take the standard deduction. I don't have to, keep receipts or prove anything. I'll just take that standard amount offered to everybody. So if you think about it, these above the line that can be used for everyone, these can be combined with the standard deduction. So if you find a way to get a deduction and still be able to not have to itemize, that's a pretty big benefit. A couple things that fall in that category. I'm a really big fan of the 401k, right? IRAs and 401ks are above the line deduction, so you're able to reduce your taxable income and then take the standard or itemized deduction. As part of the Secure Act, they started allowing $300 of charitable contributions that's above the line. So even if you're doing a standard deduction, you can still get $300 off your taxes. Not bad. And then there's a variety of other ones. HSAs are a really nice benefit, that sort of stuff. So looking for things that you don't have to itemize to be able to take advantage of is a pretty nice way to use above the line deductions. In practice, how to be implementing this, my rule of thumb is always pay taxes when they're low, avoid taxes when they're high. So the chart that's on screen is a snip from a financial plan that I'm working on for a client of mine. And it's like a perfect example of what I see all the time in retirement and just kind of the default plan that people do. So that the green bars here are ordinary federal income tax. And then the red, for all intents and purposes, are state level income taxes, payroll taxes, that sort of stuff. What I hear all the time is people will say, hey, I'm getting ready for retirement. I've just been stashing a bunch of money in my bank account. For the first 2 years, I don't have to draw from my IRA or 401k at all. I'm just going to live from my bank account. Well, what that does is it kind of violates the rule of paying taxes when they're low, right? So in these early years, if the client took just that strategy, they'd be paying basically zero in federal income tax, which is really great. But what you see is down the road, they're going to be jumping up into the 10, 12, 22, 24% bracket, right? There's years that they're going to be in the 24% bracket, when if instead I had saved some of those dollars in my bank account, paid 10 or 12% now for my 401k, and later spent the bank account when I'm avoiding 22 or 24%, that's a really big tax savings. So it's not completely avoiding taxes. It's let's figure out when's the right time to pay them and when's the right time to try and avoid them to minimize it overall. A quick reminder, talking about withholdings versus filings is really important to note. So everyone from their payroll is having tax withholdings, right? And all taxes withholding is basically, we're going to draw out an estimated amount. We're just going to hold on to an estimated tax for you. And then at the end of the year, then we'll give you back or we'll charge you more. And the reason they do withholdings is, well, this is a picture of what it used to have to look like. This guy hanging upside down as a tax collector. It was a very dangerous job to be a tax collector, right? Think of if at the end of the year, you had somebody show up and say, hey, pay us the taxes for this entire year. You wouldn't like that person very much, right? And this guy said, oh, we should really be doing some payroll withholdings, right? It makes it a lot easier because it does bite-sized chunks throughout the year, right? So if we've held too much, you get a tax refund. If we've held too little, you'll get a tax bill. And all the time I hear people say, I did really good on my taxes, I got a $3,000 refund. Okay, well, that sounds great, but I can help you get a $3,000 refund, no problem. If you want a $3,000 refund, let's just increase your withholdings, have the IRS draw out $3,000 extra during the year, and then you'll get it back when you file your taxes, right? It doesn't mean that you've saved in total taxes. It just means you've basically loaned your money to the government, and then gotten it back at the end of the year. So I'm a big fan of trying to be pretty accurate. I normally try and be conservative and say, okay, I'm fine if I overshoot by $500. That's fine. But we're always looking for ways to reduce your total tax burden, not just to shift your withholdings and your filings. That's not really saving you tax dollars. Pretty timely, some people have been asking me about the stimulus check. How is that working? Am I going to be taxed on my stimulus check? The stimulus check is considered an advanced refund of a non-taxable tax credit. So basically, it's a tax credit on your 2020 tax return that you don't have to pay any taxes on. And actually, weirdly enough, within the law, they said if you earned too much and you weren't entitled to it according to the original rules, we're not gonna charge you on that. There's no clawback of it. So if the threshold for a married couple is like 150, if you earned 175 this year, they're actually not drawing back any of that stimulus check. So not a bad gig. Okay, I got 1 minute left here. I'm sorry, trying to fit a lot into one Tele here. Last slide is our last topic, tips and tricks and thoughts. First, I like to point out the difference between tax planning and tax preparing. So a tax preparer collects all your documents together around this time each year, files the taxes and says, here's what you owe or here's what you're getting back. Tax planning should take place about October, November timeframe and say, hey, we can see what the tax burden is going to be. What if we make these maneuvers and try and reduce how much you're going to end up paying in taxes? Or how about we accelerate some income and pay extra tax this year so that in 5 years, you're going to save yourself extra thousands of dollars. So having a tax plan is a lot different than just I use an accountant or I use TurboTax. It's I have a strategy to make sure I'm minimizing my tax burden. Second is that in 2026, we are slated for a tax hike. So regardless of whether, regardless of your political feelings, 2026, we are slated to see a tax hike unless Congress makes any changes. Plan accordingly. You are likely, almost everyone listening to this is in a lower tax bracket today than if they earn the same dollars in 2026. Maybe now is the time to be recognizing some of that, right? Utilize a Roth instead of doing pre-tax. The third is if you are itemizing, reach out to me. There's a strategy called bunching where you can kind of, try and put all of your itemized deductions into one year and then use the standard the other year and kind of go back and forth. Ends up saving you dollars, maximizing your deductions. And the fourth thing is just an offer. If you want, I am happy to look over a tax return. So if you're saying, hey, I just want to make sure that I'm doing all the right stuff, let's set up some time. I'll have you submit it securely. I'll take a look at the tax return and just say, hey, have you considered this? Have you considered X, Y, or Z? Something I'm happy to do. If you can't tell, huge tax nerd, so I love talking this stuff. So feel free to take advantage of it. Most importantly, thank you. I'm sorry for running a minute over, but thank you for your time. Thank you for the business and trust that you're placing with me and with all of us at Sage Rutty. We certainly do not take that lightly. If you have questions, feel free to use the chat button, but also feel free to send me an email or give me a call. Always happy to help. And just a quick reminder, as a benefit through Sage Rutty, you have access to financial planning. So you have access to certified financial planners. Take advantage of it. It's a really nice benefit. Most people don't have a financial planner or don't think they have enough money to warrant it or just haven't taken the time to do it. Almost all of my conversations start out with the person saying, I've been meaning to do this for a long time and wish I had done it earlier. So take advantage of it. If you have any questions with a dollar sign next to it, definitely happy to help. So please feel free to take advantage of it and reach out to me. Again, my contact info is on the screen and I look forward to it.